Welcome to the Real Estate Espresso Podcast, your morning shot of what's new in the world of real estate investing. I'm your host, Victor Minash. Today is another episode in our 4-part mini-series on industrial. On today's show, we're talking about the industrial outlook across the western United States, and it's based on the Marcus Millichap second quarter 2026 industrial market reports. They had a total of 36 market reports. Now, today, we're going to be looking at 10 areas: LA, Las Vegas, Oakland, Orange County, Phoenix, Portland, the Inland Empire, Sacramento, San Diego, and Seattle, Tacoma. The broad theme is pretty straightforward. The western industrial markets are still digesting a major wave of construction, just like we saw in the southeast and in the northeast. Many locations, vacancy rose not because demand disappeared, but because new supply arrived faster than tenants could absorb it. Today, development pipelines are contracting. That creates conditions for stabilization, but a smaller pipeline doesn't automatically create demand. That existing vacant space still needs to be leased up. Let's start with Vegas. The metro added nearly 24 million square feet of industrial space over the last 3 years. Even with positive absorption, that's a ton of space, and vacancy increased by almost 10%. That is a supply problem. Construction is now falling sharply, and deliveries are expected to reach an 11-year low, expanding the inventory by less than 1%. Roughly 80% of the space scheduled for completion was already committed as of April this year. Vacancy is forecast to decline modestly to about 12.8%, while rents remain essentially flat at $12.85 a square foot. Las Vegas is improving, but it carries significant lease-up risk. So private investors continue to target smaller warehouses near North Las Vegas and near the international airport. Buying below replacement costs is not necessarily the same as buying stabilized income. If we look at LA, industrial demand remains anchored by the Port of LA and Long Beach. These ports are expected to handle more than 20 million container units again this year, supporting major industrial hubs throughout the country. Even so, vacancy has entered the low 7% range for the first time since the year 2000. The weakness is heavily concentrated in newer buildings. Properties built in the 2020s had vacancy approaching 25% as of March this year. Fortunately, new construction has slowed. Only about 2.7 million square feet is scheduled for delivery, representing inventory growth of about 0.3%. Vacancy is expected to reach 7.2%, when asking rents declined 3% to $16 a square foot. The older buildings continue to dominate the investment activity, and about 90% of recent transactions involve properties built before year 2000. These buildings may lack the specifications of modern distribution centers, but many occupy irreplaceable infill locations close to customers, close to labor and transportation. Orange County shows a similar pattern. Vacancy is higher. A lot of that weakness is concentrated in distribution centers, where vacancy reached 14%. By comparison, warehouse vacancy fell below 6% and manufacturing vacancy remained in the mid-5% range. The market absorbed about 780,000 square feet between October and March, ending 7 consecutive quarters of net inventory growth. Vacancy is forecast to finish the year around 7%, and asking rents are expected to decline to $17.90 a square foot. The important lesson is that Orange County doesn't have one industrial market. Large distribution properties are soft, smaller warehouses and manufacturing are performing a lot better. In the Inland Empire, roughly 107 million square feet of industrial space was delivered over the last 5 years, and that pushed vacancy to a near 15-year high. The pipeline is now contracting sharply, and about 10 million square feet is still expected to be completed this year, the smallest amount since 2012. Vacancy is forecast to decline to about 8.9%, although rents are expected to fall to about $12.25 a square foot. Smaller warehouses remain comparatively tight, with vacancy around 5% for properties below 50,000 square feet. The Inland Empire offers lower cost basis than the coastal markets. That could be attractive, but only if you pair that up with a realistic leasing strategy. California's new restrictions on warehouse development might constrain future supply. That could benefit owners over time, but regulation by itself doesn't create demand. Phoenix offers one of the clearest recovery stories in the West. For several years, Phoenix experienced one of the country's most aggressive industrial construction cycles. Deliveries exceeded demand and vacancy has been going up. Now, large tenants are beginning to absorb that inventory. Demand has been particularly strong along Interstate 10 and Loop 303, supported by logistics companies, retailers, and advanced manufacturing. At the same time, deliveries are expected to fall by more than half compared with last year and about 80% below the peak in 2024. Vacancy is forecast to decline to about 11.8%, and asking rents are resuming growth and are expected to reach $12.51 a square foot. The vacancy is still high in Phoenix, but at least the direction has changed, investors can pursue either lower basis lease-up opportunities or stabilized assets with existing cash flow. Sacramento has the lowest vacancy among all the major Western markets. They added an average of 3 million square feet annually over the last 5 years. Construction is almost at a standstill, with less than 300,000 square feet scheduled for completion. Vacancy is forecast to be 6.9% by the end of the year, and rents increasing slightly to $9.90 a square foot. Buildings below 50,000 square feet have vacancy in the mid-3% range. Sacramento benefits from very limited new supply, lower pricing than the Bay Area, and relatively strong occupancy. But it doesn't have the scale or the productivity of the other Western markets, so its fundamentals are comparatively balanced. Oakland, on the other hand, remains a lot softer. The metro recorded 8 consecutive quarters of increasing inventory, and that weakness is concentrated along Interstate 880 and 680, where newer speculative distribution buildings continue to struggle. More than half of this year's scheduled deliveries remain unleased as of March. Vacancy is forecast to reach 10.3% and rents decline to $17.11 a square foot. Most construction starts have paused, and that's definitely going to be necessary for stabilization, but stopping construction today doesn't fill an empty building tomorrow. Those projects will eventually need to get completed. Portland is also experiencing a gradual reset. Demand turned positive last year despite weaker port activity and subdued employment. A new private operator at Terminal 6 could provide a future boost to port-related demand. Vacancy is expected to reach 8.6% and rents decline modestly to $11.02 a square foot. The most important distinction is building size. In the larger properties, vacancy has reached about 15%, while buildings below 50,000 square feet had vacancy near 2%. Seattle Tacoma faces weaker import activity and continued speculative deliveries. Vacancy is expected to reach a record 10.4% and rents decline to $12.80 a square foot. So you're starting to see a similar theme here. The last market we're going to look at is San Diego. It's a little different because its supply has not contracted. The market recorded positive absorption after 11 quarters of growing inventory, but much of that improvement came from one large Amazon move-in. Vacancy is expected to rise to 10.9% because speculative supply continues to enter the market. Rents are expected to increase marginally to $19.80 a square foot. So what is the conclusion? First, this is primarily a supply correction, just like we saw in the Northeast, just like we saw in the Southeast. Second, the smaller warehouses are performing much better than the larger centers. Third, newer is not always better. A modern building in an oversupplied location could face years of lease-up, but an older infill property could remain highly functional and difficult to replace. Exposure to the major seaports creates both opportunity and risk. Ports create demand, but they also expose owners to tariffs, to trade volumes, to carrier decisions, and geopolitical events. Among all of these markets, Phoenix has the clearest near-term momentum, Sacramento has some of the strongest fundamentals, and the Inland Empire, which is vastly overbuilt, is moving a little bit towards balance. The opportunity is not to buy in the Western industrial market. You can't buy a market. You can buy a specific property at a very specific price, serving a specific tenant in a specific submarket. So as you think about that, have an awesome rest of your day. Go make some great things happen, and we'll talk to you again tomorrow.